Yeah. So today we would be discussing tax allocation between entities. So right, all this while we were discussing about taxes which would be there, or what are the adjustments and taxes which is there in your P&L. Now we will see when there would be tax allocation between between entities in the M&E group. When would the taxes that is paid by one entity would get transferred to another entity and vice versa. So these are the instances that we would be discussing today, and this is the discussion point. Now, before we start, what we really did do this also, but not in a greater detail, but we touched upon it. Can you tell me a few instances where taxes would be pushed down, or taxes would from which is paid by one entity would be transferred to the covered taxes of another entity? What would be the instances? Okay, let's leave the instances. Then you tell me why we are doing it. Okay, so just think about it. We'll come to that. So after completing this chapter, you'll be able to allocate cover taxes between constituent entities. Okay, using Article 4.3 framework, including a lot of things. So we will discuss all that. But why do you think taxes that is paid by one entity in the M&E group should be transferred to another entity? What would be the rationale? You tell me. So it won't be counted in in calculating 15% ETR of the paying jurisdiction. Rather, it would be calculated in somebody else. What is the key rationale? Not poem. What is the key rationale for distributing taxes, or rather, like allocation of taxes? So let's say entity A has actually paid the taxes to its jurisdiction, but what we do is we allocate it to entity B, which is in a different jurisdiction but within the M&E group. What would be the rationale of doing such a thing? Why would this chapter be studied in the first place? Just think about it. Okay, Melvin says permanent establishment. No, I mean the basic rationale why there should be an allocation. I'm not asking about poem or permanent establishment or the instances which creates it. I'm talking about the basic rationale. It's very simple, very basic, black and white thing is because you see how is ETR calculated? ETR is calculated as taxes divided by income, right? So where the income is, wherever which entity has the denominator, that should be where the taxes should also be allocated for parity. Now, if the income is somewhere else and taxes are somewhere else, what would happen? It would create inflated or deflated ETR, which is not right, right? So wherever the globe income is available, that is where the taxes should be going. Is it clear why the rationale of allocation? So we will learn this, in detail today. So yeah, why when is tax allocation needed? Tax follows income. So if income is allocated to entity B for globe purpose, so globe income is of entity B, then the tax should also be in entity B's cover tax. It doesn't matter if entity A pays it. It should be taxed where there is income. Okay. Now you tell me what are the instances where allocation of taxes happen? We had looked into two, three instances of this in detail. Yes, to match where income is, we will transfer taxes to that jurisdiction. Now, what are few examples of this? Are you understanding what I'm trying to say? Like regarding allocation, the rationale? Yes or no? Okay, I'm getting. Okay, so I'll say foreign PE. Yes, absolutely. So, in foreign PE, we discussed that PE itself is a separate constituent entity, separate from its parent. So, what happens is if the tax on PE is paid by the parent or the head office or the parent entity rather than the PE, then that has to be, allocated to the PE. Absolutely, Sahil. I think few more instances are it's basically needed in these five scenarios. Okay, one is main entity PE income. Yeah, if the tax on PE income is there in the main entity, then the main entity has to transfer that to the PE income. Second is flow through entity PE income. CFC regimes. What is CFC regime? CFC, is it a permanent establishment? No, rather it is a subsidiary which is controlled by the parent entity. So we learned about CFC regimes and allocation in the last few classes. So but we will go in at one more time. Hybrid entities, reverse hybrids, distributions. There are a lot of cases where the tax allocation has to happen, and why we do it is because we have to match taxes and income. Then only the ETR calculation would be correct. Okay. Is that background clear? Then we will get into specifics so you can appreciate the laws that is drafted much better. Can I go forward? So first we will look at PE income, right? So PE tax allocation. So when a constituent entity operates through a foreign PE, as Sahil rightly said, this PE is treated as a separate constituent entity for globe purposes. PE's income is included in the PE's jurisdiction, but the main entity may pay tax on PE income in its home jurisdiction. Correct? See, what happens is mostly there are permanent establishment rules, and let's say that I have a branch in a foreign country. The foreign country would have PE rules. But imagine for a second that this country does not have a corporate tax at all, like Bahrain. Okay, it's a PE. Who will pay the taxes on that PE? The UAE head office or the Bahraini permanent establishment? Yeah. There is no domestic tax law there which recognizes a PE and that PE has to pay taxes and all. So who would pay the taxes on PE? Wouldn't that be consolidated within the books of the parent in its home jurisdiction? So, but for pillar two, even though there is no domestic tax law, if it is a PE, as per we learned about four types of PEs, right? A deemed PE, a domestic tax PE, a stateless PE. You remember all these things? So if it is a PE in any of the four instances, then it is a PE. It's a separate constituent entity for the purpose of globe. Then income would already be there because you're preparing a P&L for that branch. But this taxes also will be allocated to it rather than it being kept in main entity. Okay. So what is the allocation mechanism? How would I allocate the tax from tax of a PE from main entity to its PE? First thing is identify the PE's share of the main entity's taxable income. So in my tax return, what is the share of PE income that I'm including in my taxable income? So that is something that I extract from the corporate tax return and use the income attribution to the PE. Okay. Now calculate the main entity's tax liability. Okay, this income is included in my tax return. So how much taxes am I paying to this particular thing? Now, how do I calculate the amount of taxes I pay on the PE income? Normally, what happens is in sometimes PE income is taxed at a separate rate. So for if you have a foreign PE, that would be taxed at a separate rate. Then you can use that rate. So whatever is the PE income you calculated into that rate. But normally it is blended. Okay, even though it is PE's income, you have to pay whatever is the tax rate that is available in the main entity's jurisdiction. So if it is blended, then you have to allocate proportionately based on PE income share. How do you allocate it? Basically, whatever is the main entity's tax, you allocate it on the basis of PE income and total taxable income. Okay, so that particular tax is pertaining to the PE income, or you take PE income that you calculated into the rate in the domestic jurisdiction. So either way. Okay. So first thing is you have to calculate how much of PE's income is there in my tax returns, how much tax I am paying on it. and then push down the allocated tax. Remove the remove that from my cover taxes, then added that to the PE's cover taxes. How simple can it be? Right? Is it clear? Just take it out from you and put it into the P. See, these things will not be separately available. That's why I'm telling you, identify the income and then extract whatever is the tax you're paying on it. Okay, so that you have an amount which you can push down to the P. This is clear. So let's do an example. So let's say that AR Holdings PLC is in UK. Okay, so its total taxable income is 50 million pounds, and income attributable, and it has a PE in Germany, and income attributable to the PE is 8 million, which is already included in this 50 million. Okay, total taxable income is 50 million, out of which 8 million is income pertaining to PE. And my corporate tax percentage is 25%. So I paid 12.5 million as taxes. How did I get 12.5? Total taxable income into 25%. Now, you can tell me how much amount will I, how much of taxes on this 12.5 million will I allocate to the PE? You tell me. I have a total taxable income of 50 million, out of which 8 million is income attributable to a PE. Okay. Now let's assume that, so this income is also transferred to the P. So what is the amount of taxes that I will be sharing to the P? So I'm getting answers. Sahil says 2 million, Reshma says 2, everybody says 2 million. So let's see, how do you got 2 million? So basically what is happening is P's share of the total taxes I'm calculating. So 8 million divided by 50 million, that means out of my total taxable income, 16% pertains to P. So what is the total tax paid? That into 16% is 2 million. You can alternatively take what is the PE income and multiply it by 25% also. Okay, the tax rate at which it was paid. So 2 million is pertaining to PE, and what do I do with it? What do I do with it? Once I know that it is 2 million, what do I do with it? I will reduce it from the AR Holdings will reduce it from its cover taxes, and the German PE will add it to its cover taxes. Okay. So UK main entity will have a cover tax of only 10.5 million, and the German PE would have now plus 2 million. Are you understanding this? It's pretty straightforward and clear. Okay. Same way you learned in globe income allocation also, the income of PE is also not included in AR Holdings PLC, right? So this 8 million will not be included. The ETR there would be 50 minus 8, 42 million, sorry, 10.5 million divided by 42 million will be used to calculate the ETR of AR, and PEs would be 2 million divided by 8 million. Okay? Yes or no? Fantastic. So that is PE allocation. But you remember we had some adjustment when it was losses. When PE was in loss, right? If the PE's income is in loss, we learned of an adjustment. You remember what the adjustment was? Okay. So if PE is in a loss, then the loss is treated as an expense of the main entity. So in that scenario, we will not be keeping a loss in PE. We will be filing a zero globe return in PE, and that loss would be treated as a taxable expense of the main entity. You remember this? We discussed about it. And subsequent PE income, say subsequently, if there is income for PE, then that would be considered as a tax and income of the main entity. Till the loss is recaptured, we will not be filing any GIR, we will be mentioning only zero in the GIR return of the P. You remember, I took an example of revaluation, reserve and all for this. Yeah. Okay. So in case of PE as a globe loss, okay, if it is a loss, then who is actually paying, for subsequent income, who's paying the taxes? Subsequent income for globe purposes, who's paying the taxes? Whose cover taxes would be increased? It would be the main entities. Because till the, whole loss is recaptured, PE would have a zero globe loss, a zero globe income and zero cover taxes. So that associated cover tax are allocated from PE to main entity if it is after a loss. Is it clear? So this is very important. It's not always from main entity to PE, but in a loss situation, when there is a loss situation and subsequently there are profits, then the cover taxes and income move from here, from the PE to the main entity. Okay? So that the numerator and denominator are matched. Can somebody give me a shout if that is clear? Yeah, okay. So yeah, but see, whenever your tax from PE is allocated to the main entity, there is a cap. So what they say is PE's income shall be limited to the highest corporate tax on ordinary income and main entities dues. So let's say that PE is in India and the main entity is in UAE. So if there is a subsequently a profit after a loss in the Indian PE, and Indian PE would pay what, 35% rate, let's assume. So whole 35 won't come into UAE. You will only get up to the highest corporate rate and on. So you will only get add a cover tax up to 9%. Is it clear? It's perfectly symmetrical, right? I mean, if I add the whole 35% into the UAE's, then my ETR will bloat up like crazy, artificial. So to avoid that, it was the main entity can only take the maximum of its highest corporate tax rate. Is that clear? Okay, don't worry, we'll be doing examples. So this is P, guys. So PE, you have to, whatever is the in a perfectly normal profit situation, it will flow from main entity to the P, right? Now, if there is a loss in PE and this loss was used as a tax expense in main entity, then subsequent profit in the PE, the taxes and income flow from PE to the main entity, subject to a cap of highest rate, highest corporate tax rate in the main entity's jurisdiction. Okay? Yeah? Now, let's understand CFC pushdown. You know what is CFC? What is CFC? We have discussed this also. CFC pushdown. CFC is controlled foreign corporation, so taxes on it is paid by the main entity because it's a controlled foreign. Even though it's a subsidiary, you are controlling it. So there is artificial tax arbitrage which is created. So in order to avoid that, you have to pay tax on the main entity as well. So a simple example is UK. UK has a CFC region. So if a UK headquartered entity or a UK parent entity has a subsidiary in UAE, which is a low tax jurisdiction, then if it is a controlled foreign corporation, there are few rules as to how controlled, like decisions are taken from there, etc. So if it is a controlled foreign corporation, then UK parent has to pay taxes on subsidiaries profit in UK. Okay, but do you think that those profits would be added to the financial statements of the main entity? Would those profits would be added to the financial statements of the, I'm not talking about the consolidated one, the standalone one. Would those profits be added into the main entity's P&L? Absolutely not, because this is a subsidiary, right? So whatever taxes, CFC taxes that is paid by main entity should be pushed down to the parent entity. Okay, so let's see. So issue is, when a parent entity pays CFC tax on subsidiaries undistributed income, parent records the CFC tax in its accounts. Right? The tax is in parent's records, but the income remains in the CFC's jurisdiction. So that creates an asymmetry. So what they have told us is this tax that is in parents record, push it down to the subsidiary. Okay. So there is a simple three steps. One is identify the CFC tax in parents' current tax expense. Don't worry about all these things. These are just examples. Okay. So identify what is the CFC tax in parents' current tax expense. Then determine the CFC to which the income relates, whether it's a blended regime or or match the CFC to the specific subsidiary. What happens is in guilty regimes and all, it won't be each subsidiary separately, but all the subsidiaries together. So that's the blended regime. Don't then you have to use allocation rules which we learned, but don't worry about it. Just match which entity it relates to so that we know where it has been pushed down and then push down the tax. It's as simple as that. Remove the parents' covered taxes, add to CFC's covered taxes, and apply passive income limitation. Is that clear? Just push down. If there is a CFC tax in the parents' current taxes, push it down to the subsidiary. Let's do an example. So let's say that before push down, the parent company is in UK. Its own tax is 5 million, but out of which 400,000 relates to CFC tax on subsidiary. Okay, so the total tax that is there in my current account or current tax expense is 540,000. It's not 540,000, rather it's 5.4 million. Apologies for the time. Okay, so this is the situation. What should I do? Or let's look at subsidiary also. Subsidiary company is in Singapore. The local tax is 200,000 and it does not have a separate CFC tax. So the total tax that it pays is 200,000 against an income of 5 million. Okay, subsidiary's income is 5 million and the total taxes pays is 200,000. So what would be the ETR? 4%. 200,000 divided by 5 million. Clear? This is just a scenario. Now, what will happen if I push down the CFC region? So, if I push, what is the amount that I have to push from UK to Singapore? You tell me. What is the amount that I have to push from UK to? Okay, Sahil, 400K. Is there any income also that I have to push down, or is it only taxes? Exactly. The income staying there at Singapore only the taxes are paid by the UK entity. So this income will not, this 5 million income that Singapore earns will not be there in parent co's P&L, right? Because it's a subsidiary only and we are not talking about consolidated FS, we are talking about standalone. So this tax we have to push down. So this 400K has to be pushed down. So what will happen after push down? So entity's own tax is 5 million. This 400,000 will not be a part of my cover taxes. Okay. Again, sorry for 500,000. It should be 5 million. Here also it is 5.4 million. It's a typo. Uh, and subsidiary company, what happens? I have already paid a local tax plus the CFC tax which is paid by the parent is pushed down to me. Right? So all this 400,000 gets pushed down to subsidiary, and the total tax that now the subsidiary pays is 600,000 on an income of 5 million, and the ETR is now from 4%, it has risen to 12%. So my top up tax is only going to be 3% instead of 11%. Are you understanding? Yeah. See, because I am a low tax entity, already the UK collected CFC tax. Now you're telling me on top of this I have to pay pillar two also. That's unfair, right? So the credit of CFC taxes is given wherever it is due. Clear? Yes, no, okay. Can you give me a shout while I sip my tea? Okay, I didn't expect it to be so quick, but thank you. So yeah. So this is CFC push down. Now I mentioned something here called passive income limitation. You noted here? Apply passive income limit. After pushing down, apply passive income limitation. This also we discussed last class, but still, for the interest of continued learning, we will discuss passive income limitation also. So, what is meant by passive income limitation? So, let's assume that this taxes is relating to passive income, not active income. So, Singapore subsidiary, this 5 million, out of which 4.5 million is from passive income like interest or dividend or like other things. So in that scenario, like even for low tax passive income would be a risk. So all the investment will go from here and not from here, right? So in order to apply that passive income limitation, without a cap, high tax parent could push down excessive CFC tax to eliminate all top-up tax in the low subsidiary, defeating the purpose of group. So tomorrow, what they will do is all the passive income would be in the subsidiary, and since there is higher taxes on the parent, and if parent pushes down that CFC tax onto a subsidiary, then there won't be any low tax subsidy also. So what they have told us, for passive income, the push down is limited to the lesser of actual CFC tax or top up percentage that is there in the subsidiary into passive income tax under CFC, which I don't worry about all that. Let's do what you have to do is, if the income that is added into parent CFC calculation is passive income, then calculate CFC's ETR before push down. So you have to calculate CFC's ETR. CFC meaning the subsidiary. Okay, so pre-push ETR, there we calculated 4%, right? So what is the local taxes divided by income? And once we get ETR, you determine the top-up tax percentage for subsidiary. So top-up tax is nothing but 15% minus pre-push ETR. And that is the cap. So the top-up tax percentage into passive income under CFC regime, or the actual CFT tax, whichever is lower, would be able to push down. Okay, we'll do an example. Don't worry, we'll do an example. So let's say that what I meant to say is, let's say MJ Singapore PT Limited is my subsidiary. Okay, now it has a globe income of 5 million and it has paid local Singapore tax of 250,000, which is 5%. Now, out of the 5 million, 2 million is passive income. Okay, so 2 million is passive income, and that 2 million is taxed in UK as CFC tax at 25%. So I paid 500,000, which is nothing but 2 million into 25,000 as a tax because of passive income. Okay. Now, what do you mean by the push down cap is, out of this 5 million, 2 million is what it is passive income, right? So what you have to do is, and how much can I push down? Maximum to the amount of taxes paid, which is 500,000, or the amount of top up tax available in Singapore. So what is the amount of what is that ETR in Singapore? It's 5%. So what would be the top up taxes? What is the top up tax in Singapore? Yeah, it would be 10%. So what they are basically saying is, if it is a passive income, how much would I kind of, okay, I didn't do the solution, then I will do here. Yeah. So what they're basically trying to say is, out of 5 million income, 2 million is passive income. Okay. And passive income, how much would it be? Passive income cap. Passive income cap is minimum of actual CFC taxes paid or top up tax into passive income. Now, how much is how much is CFC taxes paid in the parent's jurisdiction? They paid 5 million. right? Oh, sorry, 500,000. So total CFC taxes paid is 500,000. And what is the top up tax percentage, or what is the top up tax percentage of passive income? That is, you said top up tax in Singapore is 10%. Into the passive income is 2 million, right? Passive income is 2 million. So that means my total top up tax percentage of this is 200,000. So I will be, how much will I push down? Push down will be limited to, even though the holding company or the parent company paid 500,000, only 200,000 would be pushed down. Only 200,000 will be pushed down to subsidiary, and remaining 300,000 will stay in UK parents covered current taxes. Is it clear? The passive income. Why? Because if I push down the whole 500,000, then its ETR would be artificially higher. So, in order to avoid that, they are saying if it is passive income, you can only push down to the limit of top up taxes of that jurisdiction. Okay? Okay. Yes, no, not okay. Okay, fantastic. So that is the passive income limitation. Okay. But basically, we have to understand what kind of income constitutes passive income. So dividends, interest, royalties, rent, and not rent if it is passive in nature. Okay. If my main business is giving properties on rent, then that's my active income. Yeah. But all the passive income, which is not my ordinary income, will be. Is there any problem? Hello? Okay. I'll just wait because Ashik has a question. Mm. So if the CFC tax or the subsidiary has any of these included, then you have to understand what is the tax paid by the parent on these things, and it is subjected to be pushed down only after a cap. Okay, right. Now, hybrid entity allocations. Fantastic. So I don't think you would remember. So let's take a quick context. Now, you tell me what is a hybrid entity, or what is a flow through entity? What is a flow through entity? What is a flow through entity? What is a flow through entity, guys? Yes, excuse me, 2 minutes. Okay, sorry. What is a flow through entity? Why am I not getting any answers? Like unincorporatable, transparent OPA, absolutely. Tax registration under one person, tax applied on different person. Ah, okay. So flow through entity basically means that it is in the jurisdiction where it is registered, it is considered just registered or like in the it is considered as a or in the tax shall flow through owners, right? In the tax shall flow through. We have examples in UAE also. There are UAE, for example, is foundations only if you choose, right? Unincorporated partnerships in default, right? These things are a flow through entity. The tax would be paid by the owners rather than, so let's say that the tax of the total income of flow through entity is 500,000 and it is held by two other companies for 50-50%. So 250,000 would be allocated to two separate people. They have to register and pay the taxes. Okay. Now flow through entity is fine. So there could be like multiple things which could happen. Okay, since this is the case, there could be multiple things which could happen. So let's say this is the flow through entity. This is the owner's jurisdiction. Okay, and it could be perceived differently by both the jurisdictions. So its own jurisdiction. Okay, the jurisdiction where it is incorporated and jurisdiction where it is, now what will happen is there could be instances where it is transparent, it is treated as a transparent entity here. Okay, scenario one is it's treated as a transparent entity here, and it is treated as a transparent entity here also. Then what will happen for globe? Then what will happen for globe? If it is treated as a transparent entity here and transparent entity here also, then what will happen for globe? This particular entity, which is a flow through entity, will not be considered as a M&E. Rather, it's the companies which are holding it would be responsible for the taxes, right? So, in case if it is like I will. So, in case if it is both transparent, then the owner pays on ownership share. So, whatever is the ownership share, the taxes would be distributed for globe purposes. It would be distributed to, so let's say A and B are holding, A company and B company are holding this entity in 50-50 ratio. These income and taxes would be distributed to them. Correct? If it is transparent. Now tell me if it is transparent, if it is opaque in the owner's jurisdiction and transparent in its own jurisdiction, what will happen? Then who will pay the taxes? If it is such a scenario, in the owner's jurisdiction, say, this entity is recognized, is considered as opaque. That means it's a corporation. And in the, you know, in its own jurisdiction, it says it is transparent, the owners will pay. Then what will happen? Who actually pays? Who actually pays? Exactly. The owners would pay in their jurisdiction, correct? So, in that scenario, the owner shall, based on its percentage. Okay. Now, let's consider a next alternative where it is considered transparent at the owner's jurisdiction. Okay. And opaque in the this jurisdiction is considered opaque in its own jurisdiction. Then what will happen? Who will pay the taxes? Who will pay the local corporate tax? That's what I'm asking. Here and all, we are talking about who was paying the local corporate taxes. Okay. Who's paying the corporate taxes in case if it is transparent, it is considered as a transparent entity in owner's jurisdiction and it's an opaque. For example, an Indian partnership. Okay. There is a partnership in India which is owned by two UAE companies. Two UAE companies are having a partnership in India. In UAE, this partnership is an unincorporated partnership and hence it's a flow through entity. But in India, partnerships are a separate legal entity. So, in that case, who will pay the local corporate tax? It would be paid by this guy, this entity itself in India, right? Because while filing its tax return, it has to file as a, so the entity will pay. You understand what is happening? Who pays the local corporate tax? So here let's write who pays the local corporate tax. Okay. You understood who will pay the corporate tax in this scenario? Yes or no? Yeah, if it's a flow through entity in one, see the owner's jurisdiction also, it is transparent entity. And, in the its own jurisdiction of incorporation also, it is a, transparent entity, then the owner will pay, obviously. In the owner's jurisdiction, this is opaque, but in its own jurisdiction, it is transparent. Still, the owner will pay, right? Because it is transparent, it's not paying its own corporate taxes, the owner is paying. Now, if it is transparent in owner's jurisdiction, but it's opaque in its own jurisdiction, then who's paying? The entity will pay, right? Okay. Now, you tell me, in scenario one, is there going to be an allocation of taxes? Who's paying the taxes? The owner is paying, right? Not the entity. So should owner allocate the taxes to the entity? Where will this globe income in certain scenario one? Where will be the globe income staying? Is it in the owner's jurisdiction or the own jurisdiction? The globe income would be in the owner's jurisdiction. In globe rules also, if it's a fully transparent entity, okay, it's a fully transparent entity, meaning it's considered as a transparent in both the jurisdictions, fully transparent, then you need not kind of consider it as a separate legal entity for globe purpose also. It is so the parent, the income would be allocated to the parent and the tax is actually paid by the parent. So is there going to be any allocation? Are you getting the rationale, guys? Hmm? So in globe rules, if it is fully transparent, it can't come and say that okay, there is a flow through entity and you this would be considered as a separate. No, it won't. So in such a scenario, who's paying? Absolutely, the income would be in parents' books, and tax will also be in parents' book. So there is no allocation. Now let's try this one. It is a flow through entity, but not a fully transparent entity. Okay, it's a flow through entity, but not a fully transparent entity. So it's opaque in parent's jurisdiction, but it's transparent in its own jurisdiction. So is this a separate M&E for globe purpose? Answer is yes. Only fully transparent entities are not a separate legal entity. For if it is partially transparent, then it has to kind of file taxes in that jurisdiction as a globe M&E. Now, in such a scenario, would there be, allocation from parent to subsidiary or parent to the flow through entity? Answer is yes, because corporate tax who's paying? Owner is paying, not this guy. But the income would, in for globe purposes, would be here. So it makes sense that this taxes be shifted here. There will be allocation, right? Are you getting it? We are just matching where income and taxes are. So in this case, definitely there would be allocation because income would be in parents, income would be in subsidiary, oh sorry, on the flow through entity, but taxes would be paid by parent. Now in this scenario, what would be? You tell me. That means that you have really understood. The entity's own jurisdiction, it is opaque. Okay, so it's not a fully transparent entity, it is partially transparent only. So in such a scenario, will there be an allocation or not? Okay, I see that there are a lot of no allocation, but Reshma says yes, allocate. Okay. Answer is there won't be any allocation because see, where is the globe income coming in? It's there in the entity's own jurisdiction. Why? Because it's a partially transparent entity, right? So the income is here, tax is also here. So what is there left here to allocate? Nothing. So no allocation. The tax and tax stays at flow through entity level. Is that clear? So, this particular scenario where the owner's jurisdiction is opaque and in the local jurisdiction it is transparent, this is the thing that you have to be very careful. Okay, this is where the allocation shall happen. So, this is where there would be an allocation because income is here and taxes are here, so it should move from here to here. Are you understanding this example? Yeah. Okay, now let's read. I think it would be clear now once we read. But this is the whole rationale behind this. So let's understand hybrid entity allocations. So tax transparent entity. Okay, when the owner is taxed on hybrid's income, owner's tax on hybrid income is pushed down to the hybrid entity. So when the owner is taxed, owner's tax is pushed down to the hybrid. Why is it called a hybrid entity? Hybrid is like, it's not fully transparent, it is only partially transparent. See, partially transparent ones are called hybrid entities. Okay, so owner's tax on hybrid income would be pushed down to the flow through entity or pushed down to the hybrid entity. Okay, so you have to identify owner's tax on this entity, allocate to the hybrid entity, and apply passive. Yeah, here also you have to apply passive income limitation. Okay, just like how we studied the top up tax rate or the actual tax paid by the owner, whichever is lower. Now, if it is a reverse hybrid meaning it is opaque here and it is transparent here. That's called reverse hybrid. Okay. In a reverse hybrid situation, the entity is taxed. When the entity is taxed but treated as transparent by the owner, entity is taxed but treated as transparent by the owner, Tax stays within the entity, no push down required. Entity already has the tax. Is that clear? Is that clear? You, sorry. Yeah. Is this clear? And this diagram? Fantastic. Okay, let's do one question so that we are on the same page. So let's say that US parent owns 100% of Luxembourg SCS, some hybrid entity. Okay, so US parent in Luxembourg it is transparent. Okay, but US it is treated as a corporation. So in Luxembourg it is transparent, but the US treats it as a corporation. So which scenario is it? One, two, or three? One, two, or three. In Luxembourg, it is tax transparent, but in US, it is a corporation. So which scenario is it? One, two, or three? Yes, take the question again. US tax parent owns 100% of Luxembourg SCS. SCS, it's a hybrid entity. And Luxembourg treats SCS as transparent. So no Luxembourg tax. But US treats SCS as a corporation. So US taxes SCS income. And tax is 600,000 pounds. So which scenario is this in this diagram? One, two, or three? It is two. In its jurisdiction, it is transparent, but in the owner's jurisdiction, it is opaque. So, will there be allocation or not? There will be allocation. Okay. So, the 600,000 that US parent would pay would be allocated to Luxembourg. Correct? So, push 600,000 to Luxembourg SCS. Apply passive income limitation. So, this is very careful. You have to apply passive income limitation at the time when you are allocating. Isn't clear? It's pretty, once you understand the logic, it is clear. Only thing is we are matching where income and taxes are. Wherever there is denominator, side would the numerator follow. So the simple technique to understand this allocation is follow the denominator. Where is globe income, taxes would be there. Okay? It won't be duplicate in two places. It will only be in one place. So result, Luxembourg's covered taxes would be 600,000. US parent, they will have to remove 600,000 from their covered tax or their current taxes. Is this clear? Flow through entity allocations. Flow through entity, you have to be really seeing, uh, where the income is and where the taxes is. In this scenario, it is a hybrid entity. It's not a fully transparent entity. So if it's a hybrid entity, definitely it is considered as a separate M&E. So you have to see if the income, so income is always there here, correct? Except in scenario one, in scenario two and three, when it's a hybrid entity, income is here. So if the tax is here, you push down the taxes. In here, if the tax is here only, let it stay. Income is going in those in any hybrid situation, whether it is normal hybrid or reverse hybrid, income is going to be in entity's own jurisdiction. If the tax is not there, push it down. If tax is already there, keep it as it is. No push down. Yeah. Fantastic. What is the time? 6:20. Now, we will look at distribution tax allocation. Okay. Do you want to continue this or should we continue tomorrow morning? You tell me. If it is getting too heavy, then we'll stop here. We'll continue tomorrow morning and after that, we'll have one in the evening hours. What do you say? You want to consider this in the morning session? Well, let me know. Okay. So we will do this in the morning, tomorrow morning, and the remaining ones. But if I kind of take what is remaining, so yeah, yeah. So I think PE income is done, Flow through is done. CFC regime, we have completed all these, like, hybrid and reverse hybrid. You understood what is reverse hybrid and hybrid? Okay, now there is distributions. It doesn't stop there. There are more things which is going to be a little more complex. So we will do that. So don't worry about if it is too heavy. It is pretty simple, guys. What you have to understand is now numerator and denominator should be matched. That's the cardinal rule. Okay, and if it is PE, push the PE down, push the tax down from main entity to PE, because PE is a separate entity for the purpose of loan. Correct? But if it's a loss situation, then you have to apply a little difference. If it is a CFC regime, push it down to the subsidiary. The taxes push it down because the income is there. But if there is passive income, you have to apply a cap on passive income limitations. Flow through entity, you have to see if it is if it is a hybrid entity. Hybrid meaning what? This is hybrid. It's opaque in one jurisdiction, transparent in one jurisdiction. That's called hybrid. If it's a fully transparent, then no need to kind of do anything. If it's a opaque, if it's a hybrid entity, push it down, match where the income and taxes are. If it's a reverse hybrid, no need to do anything. Okay. Then distributions we'll see tomorrow. So this is basically it. I mean, it's not that hard if you kind of understand the logic, but yes, if you kind of go back and read what is the adjustments one by one, you will get it. Okay, so we will pause here, and we have a lot of ground to cover. Not just distribution. Distribution is pretty simple, but there are like a lot of things which is remaining, which we will take up next class. Now, I understand it is we are all talking about cover taxes. We have not started about deferred taxes also. So deferred taxes also, there would be allocation and something. So we will start tomorrow morning at 9:30. Okay, 9:30 sharp we will start, so that we can close by say 10, half an hour more, and then in the evening we'll take up the next. Okay, fantastic, guys. Thank you.